Happy Tuesday at 1342. It's your skipper here at Darius Dell to present our macro minute for Tuesday, January 28th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, will massive tariffs be used to extend and expand the Trump tax cuts? Our answers are unequivocally yes. We've been signaling that for months based on our understanding of the congressional reconciliation process that will be used to implement President Trump's agenda. Specifically, the Senate reconciliation process features the Byrd Rule, which features a provision to ensure budgets do not increase the deficit beyond 10 years. That means that congressional Republicans will be forced to incorporate revenues from fresh tariffs and federal spending cuts via DOGE to offset the multi-trillion-dollar impact of extending and expanding the Trump tax cuts, or the Tax Cuts and Jobs Act, aka the Trump tax cuts, from a revenue reduction perspective relative to the baseline of current law. Recall that current law has the individual income tax portions expiring on December 31st, and that represents a significant ticking time bomb for the U.S. economy that we ultimately don't think we're going to see us hit. So all told, we continue to view the advent of fresh tariffs as something that could contribute to a stock market crash in 2025, not because tariffs are the boogeyman of economic policy, like many on the political left have fearmongered in recent months, rather due to the liquidity draining US dollar strength that a significant increase in tariffs was likely to catalyze. Anything that threatens a smooth, uninterrupted increase in global liquidity from here will cause severe problems in asset markets amid peak global debt refinancing demand and a likely hawkish shift in Treasury net financing policy favoring less bills and more coupons under Scott Bessent. Refer to my recent Fox Business appearance with our friend Charles Payne for more details. Transitioning to our 42 macro dashboard here. As always, I wrap up with the question from our community. This one's regarding DeepSeek's AI disruption. Will cost-efficient AI models trigger a tech valuation reckoning for QQQ and SPY? So it's a pretty long question. Let me just read it. It says, morning, Skipper, DeepSeek's AI emergence has already driven a 2% drop in QQQ futures. That obviously got worse due to its cost-efficient AI models undercutting U.S. tech giants. Given its potential to disrupt AI chip demand, cloud spending, and open source competition, do you see this triggering a broader re-rating of tech valuations at QQQ and SPY? So the question goes on to list several risk factors. Short-term versus structural risk. Is this a transient sentiment shock? Or could DeepSeek's innovation pressure margins and growth assumptions long-term? SPY with SPY's 27% tech weighting. How exposed is it to the Q's 48% tech concentration? And then finally, mitigation factors. Could U.S. policy chips, i.e. easing export rules or accelerated R&D, offset the threat? What indicators would you monitor to gauge the severity of this risk? So really awesome question, very multifaceted. So let me just try to offer my thoughts kind of in order here. So we'll start with the first question. Do you see the DeepSeek news as triggering a broader re-rating of tech valuations in QQQ and SPY? So I think the sort of, after engaging the kind of first 24 to 48 hours of the market response, a major re-rating, probably not. I think it's incumbent upon what we hear from Meta and Microsoft with respect to earnings and guidance on Wednesday and respect to Apple's earnings and guidance on Thursday, because ultimately what really matters here going forward is, are you people spending too much money on something that effectively costs a lot less? And the answer to that is multifaceted. It's not as simple as yes or no. The reality is, one, the DeepSeek, the breakthrough developments in DeepSeek's open source AI model are something that can be copied by each of these companies, which ultimately lowers their cost of production. And it may be allowing them to reduce the overall amount of spend, in subsequent quarters and or years, and or they can take the same amount of spend and have higher levels of productivity with respect to their AI development. Recall that DeepSeek built these models using H800 chips, which are a legacy chip from NVIDIA. Imagine taking the same architecture and inference process and empowering that with H100s or even the NVIDIA Blackwells. You can do a lot more. Just potential. I don't know this stuff, like I know global macro, but from what I've read on this, you could in theory recreate a better version of DeepSeek that's more powerful, faster, with more tech spending. So it's not clear that DeepSeek has sort of won, but what I think DeepSeek has officially done is sort of announced China's foray into what is now a head-to-head race with respect to AI infrastructure development. And on the infrastructure development front, one thing I think was really positive for the markets yesterday is DeepSeek, because they don't have enough these sort of high-powered microchips, is that their servers started crashing as people started downloading and using the app. So you couldn't run as many inferences, or users were blocked from essentially, inferring on the platform because they didn't have enough, memory to actually run the app. So, I do believe that the data center build out in the US is something that has to happen. Now, does it have to happen at the prices NVIDIA are currently charging? Probably not. And so investors need to be aware that if there is some significant re-rating in the market, it's probably going to be specifically around NVIDIA and other chip manufacturers that are sort of, probably charging, exorbitant prices for their top of the line chips, when in reality, what DeepSeek has proven is that you don't need as many top of the line chips, or if you're using them, you probably don't need as many. With going back to the question here, this is will this pressure margins and growth assumptions long term? I really don't think so. I really just think it just means that we're moving further. We've taken a step forward in time as it relates to the development of artificial general intelligence, and ultimately, that's the end result here. Is artificial general intelligence replaces white collar workers like me and you and most people listening to this. And I got to imagine that's not going to be something that's going to be done with $6 million. That's going to take a significant amount of data center and infrastructure investment. You probably don't need as much investment in terms of paying software engineers to do this kind of stuff, but you will certainly need the chips and the data centers to power this kind of stuff, because if every enterprise and every consumer is running inferences on their phone or on their computer, you're going to need a lot more memory and a lot more ability to access those networks. And so I really don't know if it slows down the hyperscalers story, but it probably slows down the NVIDIA story to some degree, because again, you just don't need as many of their high cost chips. Going back to the SPY exposure, obviously, if we saw a big re-rating lower of all these companies, you're probably going to see a significant decline in both the SPY and the Qs. I don't think that's a particularly novel insight there. And then finally, with respect to mitigation factors, could U.S. policy shifts offset this threat? Of course, U.S. policy shifts could offset this threat. You potentially see even tightening of further export controls, just given the kind of rival nature of the U.S.-China relationship and the sort of bipartisan nature of kind of anti-China policies down in D.C. You could essentially have more subsidies. Obviously, the U.S. government getting the Stargate project being a factor in the Stargate project that was recently launched. I think you potentially could see more subsidies there, and certainly more defense spending associated with AI, because that's probably where the new Cold War is going to be. If it isn't started already, it's we're in Cold War number 2, if you will, with respect to AI development and the proliferation of China AI tech around the world. So that's, in my opinion, you're going to see more defense spending on that as well. And then finally, overall, I guess that the key takeaway question is, what indicators are you monitoring to gauge the severity of this risk? It's the same indicators that we monitor to gauge the severity of any market risk, whether it be upside risk in asset markets or downside risk in asset markets. I think the number one thing we do for our clients here at 42 Macro is we now cast the market regime. Are we in a risk on regime or risk off regime? And we send clear, actionable signals whenever that changes through the lens of our KISS portfolio construction process, which is a 60-30-10 trend following strategy that features stocks, gold, and Bitcoin in that order, or through the lens of our discretionary risk management overlay, which takes that market regime signal and generates tactical trade signals, specific proper trade recommendations across 70 different factors from a long and short perspective at any given time. Is essentially a risk management overlay of exactly how you should be approaching investing from an asset allocation and portfolio construction perspective based on the market regime conditions. So, whether it be KISS, Dr. Mo, or our overall market regime nowcasting process, that is how we approach asset markets first and foremost, and everything else we talk about, whether it be DeepSeek, its impact on tech and AI development, growth, inflation, liquidity, positioning, corporate profits, et cetera. Everything else we say is purely designed to help our clients anticipate the evolution of those market regime signals vis-a-vis our KISS portfolio construction process and our discretionary risk management overlay process. So if that sounds very different than how most people are incorporating, fundamental information like this, it should sound very different because this is what many of the world's top institutions are doing with respect to separating their research process, their fundamental research process from their risk management overlay. Their risk management overlay will tell them market timing and position sizing. Their fundamental research process will tell you, do I like something or do I dislike something? And the best institutions on the asset manager side in the world that I've worked with, many of them are clients here at 42 Macro, they put on positions when those two things intersect, and they do absolutely nothing when those two things are not intersecting. In my opinion, that's one of the hallmarks of institutional asset management and institutional risk management in general. So we'll wrap it up there. Gone long enough today. We'll wrap it up there. Darius Dell presenting our macro minute for Tuesday, January 28th, 2025. Best of luck out there today. We'll catch you back here tomorrow. Cheers.